Right now, thousands of people across the UK are legally paying more tax on their pension than they have to. Not because they broke any rules, not because they made reckless financial decisions, but simply because nobody ever explained how pension drawdown taxation actually works. And the mistakes people make are not obvious. They do not feel like mistakes when you make them. They feel like perfectly reasonable decisions. That is what makes them so expensive. In this video, I am going to walk you through the most common pension drawdown tax mistakes, the ones that cost retirees thousands of pounds every single year. And I want to be clear, most of these mistakes are completely avoidable once you know the rules. There is the withdrawal mistake that can silently push you into a higher tax band without you realizing it. There is the emergency tax trap that causes HMRC to deduct far more than they should the moment you first access your pension. There is the timing mistake that increases your tax bill simply because of when you choose to withdraw. There is the mistake that couples make together, thinking they are being sensible, that ends up costing them both. And there is one final planning oversight that catches even the most financially careful retirees. Stay with me, because if you are approaching retirement or already in drawdown, there is a very real chance you are already making one of these mistakes right now. And by the end of this video, you will have a clear framework for protecting your retirement income from unnecessary tax. Let us start with something most people do not fully understand when they first enter pension drawdown. Your pension is not taxed in the same way that savings accounts or ISAs are taxed. When money sits inside a pension, it grows largely free from tax. But the moment you start withdrawing from it, the rules change. Most of what you pull out is treated as income by HMRC. Here is how it works. The first 25% of your pension pot can typically be taken as a tax-free lump sum. This is known as the pension commencement lump sum, and it is capped at £268,275 across all your pensions combined. Everything beyond that 25% is taxable. HMRC treats it exactly like a salary. It is added to any other income you receive, your state pension, rental income, part-time work, any other sources, and you are taxed on the total. The current income tax bands in England work like this. You have a personal allowance of £12,570, meaning the first £12,570 of your total income is tax-free. Above that, you pay 20% basic rate tax on income up to £50,270. Income between £50,270 and £125,140 is taxed at 40% higher rate, and income above £125,140 is taxed at 45% additional rate. On the face of it, this sounds manageable, but the surprising part is that most tax mistakes happen before people even realize they have made one. The most common drawdown mistake is also the most understandable one. Most people reach retirement with a pension pot they have spent decades building. They have sacrificed and saved, and now they want to enjoy it. So when they first access their drawdown pension, many people take a large lump sum, sometimes the full amount they need for the next few years, all in one go. It feels efficient, it feels like taking control, but here is what happens when you do that. Take someone called David. David has a pension pot of £400,000. He has already taken his 25% tax-free cash of £100,000. He also receives the new state pension of £11,973 per year. In his first year of retirement, David decides to withdraw £50,000 from his remaining pension to pay off his mortgage and take a long holiday. His total taxable income for that year is £11,973 from the state pension plus £50,000 from his pension withdrawal, a combined income of £61,973. The higher rate tax threshold in England is £50,270, so everything above that is taxed at 40%. That means a portion of David's withdrawal is taxed at double the rate he expected. If David had spread that same withdrawal across 2 tax years, taking £25,000 per year, his total annual income would have been £36,973 in each year. That keeps him comfortably within the 20% basic rate band for both years, the same amount of money withdrawn, a meaningfully lower tax bill. This mistake is common, but there is another one that often creates an even larger tax bill in the very first withdrawal you ever make. This is the mistake that shocks people the most because it happens before they have had a chance to plan anything. When you make your first taxable withdrawal from a pension in drawdown, HMRC almost always applies what is called an emergency tax code. And the way emergency tax works is deeply counterintuitive. Instead of taxing you on your actual annual income, HMRC treats your first pension withdrawal as though it represents 1 month of your income, then multiplies it by 12 to estimate your annual earnings. Only 1/12 of your personal allowance is applied. Here is what that looks like in practice. Imagine you withdraw £20,000 as your first taxable drawdown payment. HMRC sees that £20,000 and assumes you will withdraw the same amount every single month. That means they calculate your annual income as £240,000. At that level, you would pay higher rate and additional rate tax on most of it. So they deduct tax on that basis immediately at source, even though your actual annual income might be nowhere near that figure. The result is an unexpected and significant tax deduction on a withdrawal you thought you understood. HMRC does offer a refund process through forms P55 or P53ZI, but this can take up to 30 days to be processed, and the money is already gone from your account in the meantime. The solution is not complicated, but it requires knowing about this trap in advance. If possible, making a small initial withdrawal first, even a nominal amount, to establish your correct tax code with HMRC before you take the larger withdrawal you actually need. This one step can prevent thousands of pounds from being withheld unnecessarily. Very few people are told about this before retirement, but even if emergency tax is refunded eventually, there is another mistake that can permanently increase your tax bill in ways that cannot be reversed. We touched on tax bans in the David example earlier, but there is a deeper version of this mistake that affects people who make large one-off withdrawals without understanding the interaction with the personal allowance. Here is something very few retirees know. For every £2 of income above £100,000, HMRC withdraws £1 of your personal allowance. This means that between £100,000 and £125,140, the effective tax rate is not 40%. It is closer to 60%. Consider a retiree called Margaret. Margaret has a pension pot of £700,000 and has been careful with her finances her entire life. Her financial advisor retires and she decides to manage her own drawdown. In one tax year, she withdraws £120,000 from her pension. She adds that to her state pension and some rental income, and her total income for the year is £105,000. Because she has crossed £100,000, HMRC begins withdrawing her personal allowance. For every extra pound she earns above that threshold, she loses 50 pence of her tax-free allowance. The result is that a portion of her income is effectively taxed at 60%. She pays far more than she anticipated. Had Margaret taken £80,000 per year across 2 tax years instead, she would have remained below the £100,000 threshold in both years, kept her full personal allowance, and paid tax at the standard 40% rate. The difference in total tax paid across those 2 years would have been thousands of pounds. This is where many pension withdrawals go wrong. The amount feels reasonable. The problem is invisible until the tax return arrives. The timing of your withdrawals can matter just as much as the amount. Most retirees think about how much to withdraw. Very few think carefully about when to withdraw. The UK tax year runs from April 6th to April 5th. That date is not arbitrary. It is the dividing line that determines how much tax you pay on any given withdrawal. Here is the mistake. A retiree needs some extra money in March. Perhaps a home repair has come up or a grandchild needs help with a house deposit. They withdraw £15,000 from their pension on the 20th of March. That £15,000 is added to all their other income for that tax year. But what if that same person already had a relatively high income that year? Perhaps they received a dividend, sold some shares, or had rental income that was larger than expected. That £15,000 in March could push them into a higher tax band. If they had waited until the 7th of April, just 18 days later, that same £15,000 would have fallen in the new tax year. Depending on their other income, they might have remained in a lower tax band. The difference could easily be thousands of pounds. The reverse is also true. If you know your income will be lower in the upcoming tax year, perhaps because rental income is decreasing or you are scaling back part-time work, it can make sense to delay a withdrawal until after April 5th to take advantage of a lower effective tax rate. This is not aggressive tax avoidance. This is legal, straightforward timing. But most people never consider it because nobody explains that pension withdrawals are controlled by the individual, not the pension provider. The next mistake is often far more expensive, and it catches people who believe they have already thought everything through because they are making financial decisions together as a couple. Here is a scenario that plays out constantly across retirement planning in the UK. A couple, let us call them Robert and Susan, reach retirement at around the same time. Both have pension pots. Robert has a larger pension, roughly £450,000. Susan has a smaller pension, around £150,000. They decide that Robert will draw from his pension to fund their shared retirement while Susan leaves hers untouched. The logic feels sound. Robert has more. Robert draws. Susan waits. But here is the problem. All of Robert's drawdown income sits on top of his state pension. His total income climbs into the higher rate tax band. He is paying 40% on a significant portion of his drawdown income. Meanwhile, Susan has her own personal allowance of £12,570 sitting completely unused. She also has her own basic rate tax band up to £50,270. Her pension is growing, but because she never withdraws anything, HMRC never taxes it during the accumulation phase. Yet if Susan withdrew a small, carefully planned amount each year, enough to use her personal allowance and basic rate band, the couple as a whole would pay substantially less tax overall. The income might be the same, the lifestyle might be identical, but by drawing down from both pensions in a coordinated way, rather than exhausting one before touching the other, the couple can save thousands of pounds in tax every single year across a retirement that may span 2 or 3 decades. Most retirees never discover this until after the money has already been withdrawn. There is one final mistake that catches even financially careful retirees, and it is the one that has the longest-term consequences. This final mistake is not about a specific withdrawal or a specific date. It is about the absence of a plan. When people retire, many of them make a simple assumption. They will take money from their pension when they need it. They will manage their spending, live within their means, and let the pension do the rest. What they do not realize is that entering pension drawdown without a deliberate annual tax strategy is itself a form of financial mistake. Here is what often happens. In the first few years of retirement, spending tends to be higher. People travel, they renovate, they support family members. So their drawdown income is high, their tax bill is high, and they use up a large portion of their pension early in retirement at an elevated tax rate. In later retirement, spending naturally reduces. They would have benefited from a more modest income during those years, but the pension has already been drawn down significantly. A better approach is to model out your pension withdrawals against your personal allowance, your state pension, and your expected other income, then draw down in a way that keeps your total annual income as close as possible to the most tax-efficient level for as many years as possible. That level is different for everyone. For some, it means drawing just enough to use the personal allowance before state pension kicks in. For others, it means using the full basic rate band each year and paying a modest 20% dollars, but never crossing into the 40% higher rate territory unnecessarily. There is also the money purchase annual allowance to be aware of. The moment you take any taxable income from a defined contribution pension in drawdown, your ability to contribute back into a pension drops from the standard annual allowance of £60,000 to just £10,000 per year. This matters for anyone still doing occasional paid work in retirement or expecting a financial windfall they might want to shelter in a pension. Taking out money before you need to could permanently reduce your future contribution capacity. The surprising part is not the tax itself. The surprising part is how much of it is optional. Let us bring everything together. The first mistake is withdrawing too much in a single tax year. The solution is to spread withdrawals across multiple tax years and stay within the basic rate band wherever possible. The second mistake is the emergency tax trap. The solution is to be aware that HMRC will apply an emergency tax code to your first taxable drawdown payment and to make a small initial withdrawal to establish your correct tax code before taking the amount you actually need. If you are overtaxed, reclaim it using HMRC forms P55 or P53Z. The third mistake is taking a large lump sum that pushes your income above £100,000. At that level, your personal allowance begins to disappear and your effective tax rate can reach 60% on that portion of your income. The solution is to keep total annual income below that threshold by spreading withdrawals. The fourth mistake is poor timing. A withdrawal made in March and a withdrawal made in April may carry very different tax consequences, depending on your other income in each tax year. The solution is to plan withdrawals against the tax year calendar and consider whether delaying or accelerating a withdrawal makes financial sense. The fifth mistake is the couple's planning mistake. 2 people, 2 personal allowances, 2 basic rate bands. Using only one person's pension while the other sits untouched is almost always less tax efficient than drawing from both in a coordinated way. The sixth mistake is having no plan at all. Going into drawdown without a multi-year withdrawal strategy means you will inevitably pay more tax than necessary in some years and miss tax-saving opportunities in others. The solution is to model your income against tax bands annually, or to work with a qualified financial planner who specializes in retirement income. Retirement income is too valuable to lose unnecessarily. Every pound you hand over to HMRC that you did not legally have to pay is a pound that cannot fund a holiday, support your family, or simply give you the financial security you worked for over your entire career. The good news is that almost every mistake covered in this video is preventable, not through complex financial engineering, not through offshore arrangements or aggressive tax schemes, simply through understanding how the rules work and planning your withdrawals with that understanding in mind. A few minutes of planning today could protect years of retirement income tomorrow. If this video has been useful, please subscribe. There is a lot more content coming on retirement income, tax planning, and making the most of your pension in drawdown. And if you know someone approaching retirement who might be making one of these mistakes without realizing it, please share this video with them. It could be worth thousands of pounds to them.